All right, so are you ready to dive into the wild world of leveraged ETFs? Today, we're going to tackle that big question. Is 2x or 3x leverage better? We've got this really interesting article that dives into it, comparing QQQ, the NASDAQ 100 ETF, with its amped-up versions, QLD, the 2x leverage, and TQQQ, the 3x.
Yeah, this is something I see people getting tripped up on all the time, that myth that more leverage equals more gains. Well, this article uses some real-world examples and kind of throws that myth out the window.
Yeah, that's what I like about this deep dive. It's not just theory. It's like, okay, let's see what actually happened. They use real market data to simulate what would have happened if you invested at specific times. And, well, let's just say things get pretty interesting.
Right off the bat, they show you this visual comparison of 2x versus 3x leverage performance. They don't give us the exact dates, but you see that 3x leveraged ETF just shooting up like a rocket. But then, bam, it crashes way harder than the 2x. It's a pretty good reminder that leverage can be a double-edged sword.
Okay, I'm already getting a little nervous just looking at that chart. So let's say, hypothetically, I went all in on TQQQ at the market peak back in 2022, held on for dear life, and then checked back in 2024. What would my portfolio look like?
Well, get ready for a surprise. In that scenario, good old unleveraged QQQ actually performed the best. TQQQ with all that 3x leverage brought up the rear.
Whoa, hold on. So much for higher leverage always wins. Timing really is everything, huh? But wait, if I'm looking at a chart, let's say starting from that market bottom in 2011, wouldn't TQQQ be the clear winner?
Oh, now you're getting to the heart of it. You're right, those long-term charts can make high leverage look super tempting, but they often show what's called time-weighted returns. And this article does a fantastic job of showing the difference between that and what happens when you make a single lump sum investment.
Okay, I'm gonna need you to break that down for me. Time-weighted returns. What does that even mean?
So it's basically a way of measuring returns that factors in the timing of your investments. It assumes you're putting money in consistently over time, not just dropping one big chunk in. Those long-term charts that start from a low point benefit from buying low and riding that wave up. But if you buy at a peak and the market dips, oof, it takes a lot longer to recover with higher leverage.
So it's not just about the leverage itself, but also about when you jump in. Makes sense. The article also mentions something called leverage decay, which sounds a little scary. Should I be worried about that?
It's definitely worth knowing about, especially with the higher leverage options. Leverage decay happens because these leveraged ETFs aim to multiply the daily returns of the underlying index. So even if the market ends up at the same point after going up and down a bunch, the leveraged ETF can actually lose value because of how it gets rebalanced every day.
Okay, so it's not as simple as 3x leverage equals 3x the return. There are these things like time-weighted returns and leverage decay that can really mess with your results, huh?
Exactly. And the article lays it all out there. They show how the recovery time after a market drop gets longer and longer with higher leverage. For example, after that 2022 dip, QQQ took about 749 days to recover to its previous high. QLD, the 2x leverage, took around 930 days. And TQQQ, well, that took a whopping 11,120 days.
Ouch. So even if you do recover, it could take a lot longer with that higher leverage. This is making me rethink my whole go big or go home investing philosophy.
It's definitely food for thought. And remember, we're talking about a single lump sum investment here. Whether that's the best approach, especially with leveraged ETFs, well, that's something we're going to dive into later. But first, let's talk about how your age and financial goals can play a role in choosing the right leverage for you. You know what's really cool about this article is how they tie leverage to your personal situation. It's not just about picking the biggest number and crossing your fingers.
Yeah, like we were saying, a long-term chart might make 3x leverage look awesome, but that's not the whole picture. Like, what if you're not starting at the bottom of a market cycle?
Yeah, exactly. They give this great example. Imagine a 25-year-old investor who throws a bunch of money into TQQQ, that 3x leveraged NASDAQ ETF. Even if they bought at the absolute worst time, like the peak of the market, they've got time on their side. Over time, they could ride out the ups and downs and still come out on top.
I'm guessing that's not the same for someone closer to retirement, like in their 50s or something?
You got it. The article makes the point that someone like that, well, they probably don't have as much time to recover if the market takes a nosedive, especially if they're relying on those investments to, actually live.
So it's not just about how much risk you can handle emotionally. It's also about how much time you have.
Yeah.
That's a really interesting way to think about it.
And then there's the whole thing about financial goals. Let's say you're trying to save up for a down payment on a house, maybe in like 10 years. The article argues that putting all your money in highly leveraged ETFs to try and reach that goal, well, it could backfire.
Because if the market crashes right before you need that money, you're kind of stuck, right? It could take years to get back to where you started.
Exactly. That unpredictability makes it a bit of a gamble if you've got a specific target and a deadline, you know?
Okay, so we talked about the potential downsides of going all in on high leverage, but the article also brings up this idea of lower leverage, specifically 2x, having its own allure. They use this really interesting comparison. They talk about QLD being like a high-spending partner and QQQ being like the frugal one.
I love that analogy. It really makes you think about your own investing style, you know? Are you the type of person who wants a chance at winning big, even if it comes with more risk? Or are you more into that slow and steady growth?
It's like choosing a teammate for your financial journey. And neither one is necessarily better. It just depends on what you're looking for and what feels right for you.
Absolutely. But here's where things get really fascinating. The article brings up some research that suggests there's actually an optimal leverage ratio, and it's around 1.7x.
Wait, 1.7x? I have never even seen an ETF with that kind of leverage.
Yeah, me neither. But that's what the research points to as the sweet spot for balancing risk and reward over the long term. And since we can't get exactly 1.7x, QLD with its 2x leverage becomes the closest thing we've got.
Hmm. So maybe 2x leverage isn't just about being the frugal partner. It might actually be the most strategic choice. This is really making me rethink my whole approach to leverage.
It definitely gives you a lot to think about, right? And we haven't even touched on whether that lump sum investment is really the best way to play the game with leveraged ETFs. The article kind of hints that there might be a more nuanced way to go about it.
Now I'm really intrigued. We've covered so much ground already, but it sounds like there's even more to uncover.
Oh, there definitely is. We've talked about time-weighted returns, leverage decay, and even how to choose the right leverage for different stages of life. But the question of how to invest, whether it's a lump sum or something else entirely, that's a whole other can of worms.
All right, well, I'm ready to open that can. Let's dig in. So we've spent this whole deep dive really breaking down leveraged ETFs, right? We've debunked some myths, explored this whole thing about time-weighted returns, leverage decay, all that good stuff. Now let's get to the nitty-gritty. How do you actually invest in these things? Is that lump sum approach the best way to go, or is there a smarter strategy when you're dealing with leverage?
That is the golden question, isn't it? And you know what? This article really challenges that traditional idea that a single lump sum investment is the best way to grow your money over the long term, especially when you bring leverage into the equation.
Okay, I'm hooked. What's the alternative?
Well, think back to what we were talking about earlier. Leverage, it just amplifies those market swings, the good and the bad, right? So if you go all in at the top of the market, you're in for a pretty wild ride, potentially.
Right, and we saw how that can really impact how long it takes to recover your losses. Even if you do end up making money in the long run, it could take a while to get there with higher leverage.
Exactly. So what the article suggests is that a more gradual approach might actually be the way to go for leveraged ETFs. Instead of one big investment, you spread it out over time.
Okay, so kind of like dollar cost averaging, but with leverage.
You got it. By investing gradually, you're basically averaging out your entry points, which can help smooth out the impact of those crazy market swings. You're not betting everything on a single moment in time.
That was a lot of sense. It was like a way to tap into the potential of leverage without being completely at the mercy of trying to time the market perfectly. This whole deep dive has really highlighted how leverage is a tool that needs to be used strategically, not just thrown around haphazardly.
Couldn't have said it better myself. It all comes down to finding the right balance for your personal goals and how much risk you're comfortable with. And you know, leverage isn't just limited to financial stuff. This article makes this really cool point about applying the concept of leverage to other parts of life.
Oh, yeah, that's right. They talked about leveraging your time, relationships, skills, that kind of thing. I'd love to hear more about that.
Okay, so let's take time, for example. We all get the same 24 hours in a day, right? But it's how we use that time that really makes a difference. Are you spending your time on things that actually matter, things that move you closer to your goals? Or are you just getting bogged down with busy work?
So it's about being intentional with your time, finding ways to make it work harder for you, just like you would with an investment.
Exactly. And the same principle applies to relationships. Building a solid network of mentors, collaborators, people who support you, it's like a force multiplier. It can really amplify your efforts and open up new opportunities.
It's like having a whole team of leverage partners, helping you achieve more than you could on your own.
Absolutely. And then there's this idea of leveraging your skills, you know, constantly learning, improving your abilities. It creates this compounding effect over time. And the more you know, the more valuable you become, the more doors open up for you.
This is really making me think. So it's about taking that leverage concept and applying it to every aspect of life, not just your finances.
It is. It's about realizing that we're all investors in our own lives. And leverage, when used wisely, can be this incredibly powerful tool for growth and achievement.
I love that. This deep dive, it hasn't just cleared up all this mystery around leveraged ETFs. It's given me a whole new way of looking at how to approach life, with more intention and strategy.
That's what we love to hear. Making smart decisions, knowing what tools you have, and ultimately leveraging your strengths to create the life you want.
Well said. Thanks for joining me on this journey. It's been really insightful. And to our listeners, remember, leverage is everywhere. How are you going to use it to reach your goals and make those dreams a reality? Keep exploring, keep learning, keep leveraging. We'll be back next time with another deep dive, so stay tuned.